Today I want to review one of the most interesting books I think I've read in a very long time. It's a book by Gary Antonacci called Dual Momentum. And this book challenges a lot of the conventional thinking surrounding asset allocation and how to mitigate risk in retirement. So in this video, we're going to talk about it.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
I'm going to break this review into a couple of different sections. The first, I'm going to share 3 problems that Antonacci talks about with respect to traditional approaches to asset allocation. Then we're going to take a look at the one big promise that I think dual momentum, the idea. Then we're going to look at what's the strategy for accomplishing this promise, the research that he shows behind this, which goes until 2011. And then I'm going to run my own independent test that goes from the out of sample period up to 2022. The first problem with typical asset allocation is that permanent hedges with bonds are costly. So here are the performance of different assets going back to 1926. And you can see that small cap stocks and large cap stocks both grew $1 to over $9,000 in the large cap stocks case and over $25,000 in the small cap space. Meanwhile, the bonds, specifically long-term government bonds, which has done better than most other types of bonds, only grew $1 to $1.75. Treasury bills, which are shorter term, only grew $1 to $22. And inflation turned the cost of everything that was $1 back in 1926 to $14 in 2019. So a permanent hedge would be something like a classic 60-40 portfolio. So to mitigate the volatility of stocks, you would keep 40% in bonds. And the idea is when the market tanks like it did here in 2008, the government bonds could increase in value or at least should retain their value. Obviously, that's been a little questioned as the 2022 has saw bonds do almost just as bad as stocks in some cases. But over a very long period of time, you would expect your overall portfolio returns to be hurt by holding bonds. So the natural conclusion would be, well, just don't own any bonds, right? Just buy all stocks. Well, the problem with that is that stocks have historically been very volatile. Here are the historical drawdowns of the S&P 500 since 1927. And you can see they get pretty severe. Back in the Great Depression, it was actually over 80% top to bottom drawdown or loss for stock investors. There's been multiple other occasions where you've seen negative 40%. And then on a very regular basis, stocks will drop by 10 or 20%. So what we've seen so far in 2022 is probably something like this. Which is really actually quite normal considering history. So buying and holding only stocks has historically had a very big payoff, but has also had some pretty big short-term pain that comes with it. Most people simply cannot handle this kind of drawdown. When it happens, they end up selling at the bottom and locking in all of these losses. Very, very, very few people are actually able to ride out this kind of volatility, particularly if you are retired and now counting on your portfolio to cover your expenses. And the final, probably biggest problem is that people make bad investment decisions. These are the 20-year annualized returns by different asset classes. So going from 1999 to 2019. Since then, the REITs have actually had the best performance over that time period. Here's the S&P 500 at 6.1%. This is a 60-40 portfolio of 60% stocks, 40% bonds, up 5.6%. Then you've got bonds and homes. And then you see here, the average investor generated returns of just 2.5%. And keep in mind, inflation was 2.2%. So the average investor only increased their real net worth by 0.3%. And if we assume most investors just buying a simple balanced portfolio would have been somewhere between 60-40 and 40-60. That would be 5.5%. People made horrible decisions. They underperformed even one of the most conservative portfolios by about 3%. And even if they just bought and hold bonds, which are typically considered the least risky investment, they would have made more. And the reason is that people jump in and out of different asset classes. So maybe, this 11.6%, right? Maybe REITs did really well. And so they would have bought in here, and then REITs did poorly. And so REITs were doing poorly. And so they said, well, REITs aren't doing well, so I'll jump into stocks, right? Which had been doing poorly, but have started to do well, so they jump out here and get into stocks here right before stocks go down. Then they say, well, the stocks have been doing poorly. I'm going to get out and jump into bonds, which have been, more stable. And so they sell here and buy here. So it's just this vicious cycle of timing, bad timing, and it causes the average investor to do very, very poorly. So the one big promise that Antonacci's book makes is that there may be a way to earn stock-like returns with bond-like risk. And he's going to do that by using something called dual momentum. So first, we're going to talk about what is momentum, and then we're going to get into relative momentum, which is one of the components of dual momentum. The second is absolute momentum. So he combines relative and absolute momentum to create his dual momentum system. So let's first talk about what he means by each one of these terms. So first of all, what is momentum? Basically, the idea of momentum is that an object that's in motion will stay in motion, right? It's just like physics. If you throw a rock, right, it's going to continue to move in the direction that it was thrown unless it's acted upon by an outside force. In this case, it would be gravity or maybe a tree, right? Something is going to have to stop that momentum, but in the absence of anything stopping it, its tendency is to continue in the direction that it's going. It's the same with stocks. Stocks that have been going up tend to continue going up, and stocks that have been going down tend to continue moving down. So they tend to stay in the same motion they've been going, unless they get acted upon, by the Fed or something. So now, what do we mean by relative momentum? So relative momentum is simply comparing the historical performance over some period of time for two different assets. So this will say, hypothetically, we have Adobe is down 51% over some time period, right? We'll say the last 12 months. I just made these numbers up. But Adobe's down 51% and Apple is down 25%. Obviously, both of these stocks are negative, but in this case, Apple would have the better momentum, right? Because it has gone down less than Adobe. So Apple has better momentum than Adobe. So now let's take a look at absolute momentum. So absolute momentum looks at the absolute returns of a particular asset class. So in Antonacci's research, what he does is he looks at compared with the risk-free rate, which is Treasury bills. So let's say over the last year, Treasury bills are up 2%. So absolute momentum says that you would want to invest only in assets that have done better than Treasury bills. So if stocks are down 25%, that's less than +2, so you would not invest in stocks. International stocks are down 30, you would not invest in international stocks. And if bonds are down -15, you would not invest in bonds. So there's some absolute criteria for returns that an asset has to beat in order to be invested in. So how does all that play into dual momentum? So let's say we have another scenario where Treasury bills are up 2% and US stocks are up 20%. So the first decision is to say, am I going to invest in US stocks or not? The answer here would be yes, because the returns are better than Treasury bills. So that's the absolute part. You're investing in whichever asset class has the absolute best performance relative to Treasury bills. And then within that, you're going to look at the relative performance. So a simple way to do it would be maybe you look at growth, right? So let's say maybe like VUG or value, VTV. So in this case, you're going to say, okay, we're going to invest in US stocks, but which type of US stocks are we going to invest in? Now we're looking at relative momentum between these two types of stocks. In this case, growth would have the better momentum. So you would invest in US stocks and that would go into growth. And again, all these are just kind of hypothetical numbers. Obviously, growth has gotten killed. So this is pretty obviously a hypothetical example, but just to clarify that. So that's how dual momentum works. Now let's take a look at the research behind this strategy. So first of all, the research on relative momentum. There's all kinds of research for this, starting in a 1937 paper by Callis and Jones. They found that from 1920 to 1935, the tendency was for whichever stocks that have gone up more than the other half tended to also go up in the next year. Over 30 years later, another study by Levy found that the stocks that were among the 10 highest appreciated stocks over the last 26 weeks, which is basically 6 months, tended to go up by 9.6% over the next 6 months. On the other hand, the stocks that were in the 10% weakest over the last 6 months tended to go up only 2.9% over the next 6 months. A 1993 study by Jagadish and Titman basically found the exact same thing as the previous two studies from over 60 years before. They found that the best performing stocks over the last 6 to 12 months outperformed the losers by 1%. Actually, this per month, not per year. And that was from 1965 to 1989. And then they actually updated the study in 2001 and found that the period from 1990 to 1998, which obviously they did not have data for in the initial study, those again outperformed by 1% per month. And since 1993, there have been over 300 academic studies, and those research has broadly found that momentum has worked in all kinds of asset classes across 40 different countries. And a 2012 study found that momentum worked in the United States, even going back to 1801. And what's most surprising about momentum is that it doesn't seem to go away. A 1993 study by Schwert found that of all the different characteristics of value, size, calendar effects, momentum, all of the anomalies disappeared after discovery, right? So once someone finds that this works, then they tell someone about it, then that other person does it too, and eventually you compete the benefits away, but the only one that remained was momentum. And even the basically fathers of the efficient market hypothesis, Fama and French, said that momentum is the premier market anomaly. So that's relative momentum. What about the research behind absolute momentum? Moskowitz published a 2012 study of 58 different asset classes, and he looked back of their past performance from 1 to 48 months. He found that using the last 12 months produced positive profits in all 58 asset classes. And buying a portfolio of those asset classes that showed positive momentum had a 2.5 times higher Sharpe ratio, which is basically a measure of risk-adjusted performance. Another study by Hurst, and Peterson, also from 2012, found that the absolute momentum was just as robust as relative momentum. They did a very similar study across different markets covering commodities, equities, bonds, and currencies. And again, they found that using absolute momentum was consistently profitable going back to 1903. And they even subtracted 2% annual fees and 20% like hedge fund fees on profits, and still absolute momentum was effective. So what about dual momentum? Now here's where Antonacci's research comes in his book. So his first question he looks at is, did the asset outperform treasury bills over the last year? If the answer is no, then you would invest in treasury bills for the next month. And if the answer was yes, then you would invest in that asset. The second question is, within that asset, which performed the best? So he looked at the US and global. So if the US was the best performing, he invested in the US. If international stocks did better, he would invest in international stocks. And using those rules, he found that dual momentum, so combining both absolute and relative momentum, produced returns of 15.79% with an annual standard deviation of 12.77%. The maximum drawdown top to bottom was 23%, and the percentage of months that were profitable was 73%. Meanwhile, just buying either the US or AFA, right? So it's the Europe, Africa, and the Far East. That generated 13.5% annual returns. And then just buying and holding US versus international roughly produced 11.5% each. And in all cases, the standard deviation is higher. This is kind of a proxy for risk. The real sign of risk, in my opinion, is max drawdown. Again, you see that dual momentum reduced the drawdown by half. Here is what that would look like in chart form. So you can see the blue line is the dual momentum strategy, the orange line being the US only, and the international fund being in purple. And you can see the biggest benefits are certainly at these extremes. So when the market is tanking, this strategy has historically done a good job of getting you out of the way. So now the question is, how has this strategy done if you update it for the basically last decade? So I ran this actually using Allocate Smartly, which is a service that I subscribe to, not affiliated with me in any way. I really like it. I'll put a link in the description below. But here's how the dual momentum strategy has compared to a 60-40 stock bond split benchmark. And this table is shown in log. And so you can see really since 2010, the strategy really hasn't done that much better than just a simple 60-40 strategy. However, since 2022, it's definitely done better this year. And I think I would expect it to do better if you did get into a true financial crisis type scenario. This strategy would tend to help you outperform. The annualized return over my particular backtest from Allocate Smartly, again, this is the source, was 14.4% compared to a 60-40 portfolio at 9.2%. You also see the maximum drawdown is quite a bit lower than the 60-40 strategy. The main negative here is that you do have a pretty significant amount of turnover. This is not going to be very effective in a taxable account. You also have potential transaction costs that go along with this. But as a whole, I think dual momentum is a really interesting strategy. You can read about it in the book. I would encourage you to get that. I'll put a link in the description down below if you're interested in reading that for yourself. Does the strategy make sense to implement? I think in certain cases it may make sense. I don't think there's a reason that someone like me would consider it. I mean, I'm fine with the market going down a lot, and I'm just fine to kind of consistently buy over and over. But for someone who's retired and maybe they don't want to have a permanent hedge to bonds, but they still want some way to potentially mitigate the downside risk of their portfolio using momentum, this could potentially be something they would want to consider. Again, do your own research, read the book for yourself to see if it's something that you might be interested in. But at minimum, it's a very interesting concept, particularly in relation to this versus a 60-40 strategy. Would it make sense? I think it's definitely worth considering. So anyways, that's it. Just want to introduce this really interesting concept to you. The biggest risks, obviously, are that it doesn't work. Maybe all this research on momentum worked in the past, but it's not going to work in the future. Obviously, you have big risks with like a 1987 or 2022 type big market collapse, very sudden shifts. A strategy like this is certainly not going to pick up on something like that. So that's not going to work there. And then there's always the risk that, you're just going to be in a sideways market and be jumping in and out at basically the worst possible times. This strategy would absolutely do poorly in that type of environment. So again, for me, I'm just going to keep buying and selling. I was considering maybe doing this as a little bit of an experiment. But I'm not planning to, change my strategy at some large scale to use something like this, at least not at this time. But anyways, thought it was interesting and worth sharing. So thank you for watching, and I will look forward to seeing you in the next video.